Three of the most anticipated private companies on Earth are moving closer to the public markets: SpaceX, OpenAI, Anthropic. And if you are waiting for the day you can finally buy them in your brokerage account, there is one uncomfortable idea you need to understand before the headlines arrive. You may not be getting in early, you may be becoming the exit. That does not mean these are bad companies. In fact, the opposite may be true. They may be among the most important companies of this decade. But a great company can still be a terrible investment if you buy it at the wrong price, at the wrong time, from the wrong seller. And that is what makes the coming IPO wave so dangerous for ordinary investors. As of June 2026, the numbers are almost hard to process. OpenAI announced a private funding round with $122 billion in committed capital at an $852 billion post-money valuation. Anthropic announced a $65 billion Series H round, valuing the company at $965 billion. And SpaceX has reportedly been exploring a public offering that could value the company at roughly $1.5 trillion. Add those numbers together and you get more than $3 trillion of private market ambition heading toward public market attention. But notice the word I used, ambition. Private valuations are not the same thing as public market prices. A private funding round is negotiated by a small number of investors with special terms, preferred shares, rights, protections, and strategic motives that retail investors usually do not get. When you buy a common share in the public market, you are often buying the simplest version of the deal. The insiders got the complexity. You get the ticker symbol. So before we talk about whether SpaceX, OpenAI, or Anthropic are good businesses, we need to talk about the machine that brings them public. Because an IPO is not just a celebration, it is a liquidity event. That phrase sounds boring, but it tells you almost everything. Liquidity for whom? For founders, early employees, venture capital funds, growth funds, and strategic investors who have been holding private shares for years. They took the earliest risk. They funded the company when it was smaller, stranger, and harder to believe in. If the company worked, their paper wealth exploded. But paper wealth is not the same as spendable wealth. An IPO helps turn that paper wealth into cash. Where does that cash come from? From the buyers on the other side, from institutions, from index funds, from retirement accounts, and eventually from people like you buying shares on an app because the company name feels like the future. This is the part most retail investors misunderstand. When a legendary private company finally goes public, you are not stepping into the first chapter. You are stepping into a chapter where many of the earliest characters are trying to reduce their risk. The venture investor who bought years ago may still believe in the company. The engineer who has stock options may still love the mission. The founder may still be all in. But the IPO creates a door. And once that door exists, some people will use it. That is not evil. That is how the system works. But if you do not understand the system, you can mistake someone else's exit plan for your opportunity. The most important mechanism here is the lockup period. After many IPOs, insiders are restricted from selling for a period of time, often around 90 to 180 days, depending on the offering. That restriction matters because it delays a flood of supply. On day one, a company may look scarce, the float may be limited, demand may be loud, the media coverage may be relentless, but months later, when lockups expire, more shares can enter the market. Academic studies do not show that every lockup expiration causes a massive crash. That would be too simple. What the research does show is more subtle and more useful. Lockup expirations are often associated with higher trading volume and negative abnormal returns around the expiration window, especially for venture-backed companies. In plain English, when insiders finally become able to sell, the market often has to absorb new supply. Sometimes the stock handles it, sometimes it does not. Either way, the lockup date gives you information. If insiders rush for the door the moment they are allowed to sell, that tells you something. If many insiders hold, that also tells you something. The point is not that you should automatically buy or automatically avoid. The point is that you do not have to be the person making a decision before the information exists. Patience is one of the only advantages retail investors have, and IPO hype is designed to make you throw that advantage away. Now let us bring this back to the three companies everyone will be talking about. Start with SpaceX. SpaceX is not just a rocket company anymore. It is launch infrastructure, Starship ambition, Starlink satellite internet, defense contracts, and one of the most powerful founder brands in modern business. There is a serious bull case here. If Starlink continues to scale, if launch demand keeps expanding, if SpaceX keeps lowering the cost of access to orbit, the company could deserve a valuation that looks absurd by old standards. But even with SpaceX, the question is not just, is the company incredible? The question is, what exactly are you buying, at what valuation, with what rights, and with what risks? If SpaceX goes public, read the filing carefully. Are you buying all of SpaceX? A tracking stock? A carved-out Starlink business? A bundle of businesses with very different economics? What voting rights do common shareholders actually have? Do not assume the story in your head is the security in the filing. The filing is the product. Read the product. Then there is OpenAI. OpenAI is one of the most important companies in artificial intelligence, but it is also one of the most structurally complicated. It began as a non-profit research lab. It later created capped profit and for-profit structures. It has major strategic relationships with some of the largest technology companies in the world. It spends enormous amounts of money on compute, data centers, research, and talent. The bull case is obvious. If AI becomes the next computing platform, OpenAI could be one of the companies that captures the operating system layer of the future. But the risk is also obvious. The costs of staying at the frontier are enormous. Competition is intense. Open source models keep improving. Enterprise customers may adopt AI quickly, but they may also switch quickly if performance, price, or trust changes. OpenAI may become one of the greatest companies ever built, but if it eventually enters the public markets at a valuation that already assumes perfection, public investors may be paying today for profits that still have to be proven tomorrow. That is not a reason to dismiss it. It is a reason to demand evidence. Then there is Anthropic. Anthropic has become one of the most valuable AI startups in the world, and it has been moving fast toward the public markets. Its cloud products, especially in enterprise and coding workflows, have become a major part of the AI adoption story. But Anthropic also has a structure that every investor should understand. It is a public benefit corporation. That means the company is built to consider a broader mission, not only shareholder value. That may be exactly the right structure for an AI safety-focused company, but if you buy the stock, you need to know what that means. You are not just underwriting revenue growth, you are underwriting governance. You are trusting that the company's mission, board decisions, and financial interests will remain aligned enough for public shareholders. Again, that may be a reasonable bet. But it is not the same bet as buying a simple software company with a simple mandate to maximize shareholder returns. Across all three companies, the same theme repeats. The technology may be extraordinary, the market opportunity may be enormous, the founders may be brilliant, and the stock may still be dangerous if the entry price leaves no room for reality. This is the part of investing that sounds boring until it saves you. The price you pay is the only variable you actually control. You cannot control the next model release. You cannot control launch cadence. You cannot control compute costs. You cannot control regulation. You cannot control whether competitors catch up. You cannot control whether insiders sell. You control one thing: the price at which you choose to buy. That is why history matters. The dot-com crash was not a story about the internet being fake. The internet was real. The future was real. The problem was that many investors paid prices that required every dream to come true immediately. Some companies disappeared. Some companies survived and became giants. Amazon lost more than 90% of its market value from its dot-com peak before becoming one of the most important companies in the world. That is the lesson. Not that innovation is bad. Not that hype is always wrong. The lesson is that even the right thesis can destroy you if your timing, sizing, and price are wrong. The SPAC boom taught a similar lesson in a different wrapper. In 2020 and 2021, investors were told they could access the future early. Electric vehicles, space companies, sports betting, fintech, battery technology, flying cars, all of it. Some of those businesses were real, some were not ready. Many traded poorly after the initial excitement faded. The wrapper changed. The pattern did not. Retail investors were sold access. Insiders received liquidity. And public market buyers had to live with the valuation. That is the trap. Access feels like opportunity, but access at the wrong price is not opportunity. It is inventory. You are buying what someone else is finally allowed to sell. So what should you actually do when a company like SpaceX, OpenAI, or Anthropic goes public? First, do not make an IPO day decision. IPO day is the noisiest possible day to evaluate a company. The media is loud, the narrative is fresh, the float may be limited. Everyone wants a take, everyone wants to say they got in. But investing is not a social performance. You do not need to prove that you believed first. You need to survive long enough to benefit from being right. Second, read the S-1. The S-1 is the registration document a company files before going public. It is not perfect, it is written by lawyers, it will still be polished. But it is one of the few places where the company has to lay out the actual business, risks, ownership, revenue, losses, customer concentration, use of proceeds, share classes, and insider selling plans. Look for the boring parts. That is where the truth usually hides. How much revenue is real and recurring? How much money is the company burning? How dependent is it on one partner, one customer, one supplier, or one founder? Who controls the votes? Which shareholders are selling? What happens after lockup? If you cannot understand the filing, you probably should not buy the stock yet. Third, wait for earnings. Private companies can live in side stories for a very long time. Public companies have to report. Quarter after quarter, the story meets numbers. Revenue, margins, cash flow, guidance, customer growth, capital expenditure, dilution, debt. The first few earnings reports after an IPO tell you how the company behaves under public market pressure. Does management communicate clearly? Do costs scale down as revenue scales up? Does the company hit targets without changing the definition of success every quarter? These are not small details. They are the difference between a business and a beautiful narrative. Fourth, decide your price before the crowd decides your emotion. If you want to own one of these companies, build a watch list before the IPO. Write down what revenue multiple you would accept. Write down what cash burn would worry you. Write down what governance structure would make you walk away. Write down the maximum position size you would allow. Do this before the ticker exists, because once the ticker exists, the emotional game begins. Fifth, size it like you can be wrong. This is where many people lose discipline. They say, if this is the next Amazon, I need to own a lot. No, if it is the next Amazon, you do not need a reckless position to benefit. A small position in a true generational winner can still matter. But a large position in a company priced for perfection can damage your financial life if the story breaks. For most investors, a speculative single-name position should be small enough that being wrong is annoying, not life-changing. That might mean 2%. It might mean 5%. For some people, it might mean 0. The number is personal. The principle is universal. Never let one story control your future. And finally, remember the difference between a business and a stock. SpaceX can change the space economy, and the stock can still disappoint for years. OpenAI can transform software, and the stock can still be too expensive. Anthropic can build extraordinary AI systems, and public shareholders can still face governance, dilution, or valuation risk. The business is what the company does. The stock is what you pay to own a piece of what the company does. Those are related, they are not the same. This is why the coming IPO cycle will be such a test. The companies are real, the technology is real, the excitement is real, but the incentives are also real. Insiders want liquidity, banks want fees, media companies want attention, platforms want trading volume, and you want a chance to own the future, those incentives collide on IPO day. The only way to protect yourself is to slow the game down. Read, wait, compare, size, then decide. Not because fear is smarter than optimism, but because disciplined optimism is the only kind that survives. The door to these companies may open soon. Just remember what kind of door it is. For early investors, it may be an exit. For you, it should only be an entrance if the price, the evidence, and the risk all make sense. You do not have to be first. You have to be right enough, patient enough, and small enough to stay in the game. This video is for education only. It is not financial advice. Before making investment decisions, consider your own situation and speak with a qualified professional if needed. If this changed how you think about IPOs, subscribe. We go deep on the financial decisions that actually determine wealth outcomes without the noise. See you in the next one.